Okay.
Perfect.
All right. Good morning. Good afternoon, folks. Hey, everyone. This is Yuman from ChurnZero, just welcoming people in. Um, Thanks for joining us. We'll start in about a minute or two, so give folks a chance to come in. Um, Randy, how are you? Real
Great,
quick.
Yuman. It's so excited to have this conversation. I know we've known each other for years and really appreciate the invitation. So looking forward to it.
Yeah, it's a topic where the CFOs and CCOs, I mean, look, I'm hoping everyone works together, but you know, they don't always. So it'll be a good conversation. All
Well,
right.
it
Well,
is
hey, welcome,
interesting.
folks. Yeah, go ahead.
I mean, well, we've been in the space. I was at customer success at Salesforce, and honestly,
Mhm.
I never talked to the CFO. And so now coming over to
Oh,
Maxio, where we sell into the CFO, I'm like, wait, you need to talk to your CCO colleagues. Like, like what you and I have been chatting about, Yuman, this whole idea of how do you
uh,
connect company data with customer data, and how
right.
important it is, especially obviously as a SaaS company, to be able to use the business metrics to inform which customers you focus on, how much you spend on them, and then have that input from the customer side going back to the CFO to be able to build the plan. I mean, we're all in it right now, building the plan for next year, and we're
Oh,
looking through our
yeah.
customers and trying to figure out who's green, yellow, red, and so I think it's a untapped, or the bridge has not been built the way it should be between the two functions.
I think you're exactly right. Well, we are definitely going to dig into this and welcome everyone. In fact, let's go ahead and get started. So, good afternoon. Hey, and thanks for joining us today. Really appreciate it. I know it's a lot of time to spend on webinars. I'm Yuman Tsang, and I'm the co-founder and CEO here at ChurnZero. And I'm just really glad to welcome you all to our webinar. It's titled From Revenue to Retention, and it's syncing the CFO and the CCO goals and perspectives. But before we actually get started in the webinar, I'm going to remind you that we are recording the session, and a link to the recording will be available tomorrow. And throughout the presentation, go ahead and submit your questions for Randy and for me via the Q&A button at the bottom of your screen. And we'll try to address as many of them as we can. Um, so I'm pleased to introduce my co-presenter today, Randy Wootton. Randy is the CEO of Maxio, and they are a financial operations platform designed to meet the unique financial needs of B2B SaaS. And that includes billing, subscription management, revenue, expense recognition, SaaS metrics, and analytics. Actually, we are customers for a very long time of Maxio at ChurnZero, and I see a lot of reports, about all our financial metrics coming from Maxio. So I'm excited to kick off the webinar with Maxio. Randy, welcome, and thanks for joining us.
Oh, it's my pleasure. And as you know, I've been a big fan of you and your company. In fact, we're just working through our final stages of implementing you guys at
Yeah.
Maxio and are excited to see the power that's unleashed with your technology. So, this vision that we're talking about, bringing the two data together, what's going to be great is we're going to be drinking our own champagne around that and figuring out how do we connect the data across our different companies in a way that we can talk about and share with the broader audience, both the CCOs and the CFOs going forward.
Yeah, and those of you in the audience who are Maxio customers and ChurnZero customers, or both, we do integrate with each other. So, you do get the benefit of joining the customer data and the company data, and it does make it easier for CS folks and finance people to stay aligned. All right, hey, let's get started. But before we do, I just want to do a quick poll. So Corey, who's working the back end, let's go ahead and do this poll. And I'm going to actually ask the CCO in the audience, or if you're not a CCO or not in CS, pretend you are. Okay. And so my question is, if you were in the CS space, which CXO which you really want as your number one ally, right? You have to choose one. You can't choose two. This person is going to be by your side, fighting the battle with you, you know, getting budget, convincing the CEO for resources, whatever it is. Uh, you know, who do you want on your side? Is it the chief financial officer? Is it the chief sales officer? Is it the chief marketing officer? Or the chief product slash technology officer? I know that's two folks, but I decided to combine it into one. Um, so we'll give it a few more seconds, and then we will end the poll. All right. So once again, if you had to go into battle for corporate resources and trying to win the hearts and minds of the company, who would you go with? And I'm going to end the poll now. I'm going to share the results, and Uh, Hopefully everyone can see that. Well,
Mm,
the chief product officer
mm,
and the chief technology officer is number one. The CFO is actually a close number two. The chief marketing officer has gotten very little love there. Look at that.
hmm. Yeah.
Does it surprise you, or does this make sense to you,
Well,
Randy?
I think the chief product officer does not surprise me because I think often service is the buffer between the promise and the reality of the product. And so, CCOs are trying to get product to build more
That's right.
capability to because their teams are suffering from implementation to adoption to support. And so they get a lot of pressure around driving efficiency in their organization. And a primary way for them to do that is have the product be better and additional tools. I was surprised that CFO was thought of as more of an ally than the head of sales, because I also think of being CS as having to clean up what sales sold.
Right.
And
Well, that's not your ally.
yeah, maybe
Yeah,
true.
yeah, yeah,
So maybe it doesn't surprise me in terms of the CCO knows that they have a lot of bodies, and
yeah,
so it's often a line item when 70% of a SaaS P&L is going to headcount, like they're always in the bullseye. And so
yeah.
getting a CFO to believe that the investment in CCO pays off and improve gross retention and net retention, makes sense.
Yeah.
It sets us up for the conversation.
Well, in fact, one of the things that I actually, if I were a CCO, I would really be close to the CFO, and here's my reason. There's one person in the organization that really understands the power of retention more than anyone else, more than the CEO, more than the chief product officer, and that's the CFO. The CFO knows the power of retention and what it does for profitability, what it does for everything. So anyway, we'll talk about that. In fact, one of really the idea behind this conversation, Randy, and it's not 2024 unless I have a AI image
Right, of
here.
course.
And the
Brilliant.
the idea is that we CFOs and CCOs often will have different sort of perspectives on success, right? They have different metrics and whatnot. And so our goal here today is, we're going to be talking about the metrics, and maybe just get into maybe a little bit of the nuances, the pluses and minuses. And for those of you who are on the finance side on the call, maybe you'll hear the perspective of the customer side, and then vice versa. So that's really why we're here today. All right. Well, why don't we start with actually shared metrics? These are metrics that both the CFO and the CCO know about and should care about. And we're just going to go over them really quickly. Okay. One is, of course, annual recurring revenue, or ARR. Okay, which is really the total annualized value of your predictable recurring revenue generated by subscriptions and contracts. So just a simple example. I'm not going to go over the examples, but ARR is, what everyone should be thinking about, know about for subscription businesses. So, I'll just start with that, and then we'll move into gross revenue retention. And the gross revenue retention is really the recurring revenue from existing customers. Oddly enough, it includes contractions, but excludes upsells and expansions. So in other words, if you renew your customers, but some of them actually kind of got smaller, right? They maybe lost seats or whatnot, you get dinged for that. But if some of them actually grow, you don't get credit for that. Randy, what do you think? Does that sound fair to you, GRR?
Well, I think that is the technical definition. And one of the things about all these metrics we're talking about, ARR, growth retention, is they're non-GAAP. And so I think one of the
Non-GAAP.
big challenges in the industry is people make up their own stuff. And especially early stage companies, if you don't have a finance person, you're trying to figure out and you're just going to make up ARR or gross retention. So I would turn to companies like ours or others to find out what the industry standard is. I would say my experience is some people will draw a distinction between gross retention, gross revenue retention, and gross punitive revenue retention. Gross retention only being accounting for lost, not the full churn. Churn being defined as loss plus contraction, but gross punitive retention being inclusive of both. So the broader definition I agree with. I think it is helpful to look at, like, you had a customer cohort at the beginning of the year. Where did you end up at the end of the year in terms of they were paying you $100? And then you just layer in these other components: gross retention, gross punitive retention, and then the next one, which you'll tee up in a sec.
Yeah. In fact, I think maybe the lesson, I mean, really the advice for those of you in the audience is these are, look, you hear these terms, you have to know these terms, you have to try to do apples to apples with these terms, but they are not GAAP. GAAP means generally accepted accounting principles, which means that a bunch of people have blessed it and said this is what it means. So there could be some apples and oranges when you talk about ARR, GRR, and the next one is NRR. So just be really careful about that. But in general, when people say NRR and GR, they do mean these definitions. So for NRR, it's really the amount of recurring revenue that comes back from existing customers, and it includes everything: upsells, downsells, expansions, churn, whatnot. And so NRR is probably what you'll hear the most. And for sort of companies in the long term, what people really think about, maybe slightly more than GRR. So, the
Yeah,
example on the screen. Go ahead,
I would say
Randy.
so. My experience, and I haven't done a lot, but talking to my VC and PE friends, if you aren't north of 90% in for a call it mid-market solution, not the super high enterprise, they're going to actually have higher gross retention, and not the super low SMB, S of SMB, they're going to probably have a lower gross retention. But if you're kind of in the mid-market space, average ACV from $7,000 to 40 or $50,000, the investors want to see at least 90%, or they start to dig and try to figure out what's going on, because that's
90% for which one?
gross retention,
For
gross
gross
retention.
retention. Right.
And then net retention, I really think the minimum they want to see is 100%, because that means that at least you're growing and you're not digging yourself out of the hole each year. The other thing I would say, Yuman, which I found interesting coming to this company, Maxio, is you got to be really thoughtful about what's your business model and how are you monetizing your customers. So, for example, with pricing. So one thing that would lead to an expansion could be a price increase, or your business model is tied to trailing 12 months of revenue. Like, it's a different dynamic than just seats versus divisions in terms of contraction or loss of seats. So I think it's double clicking on each of these in terms of what's happening across your upsells, your expansions, monetization, pricing, downgrades, loss of seats, or business contraction.
Right.
Understanding of customers' businesses are contracting is going to impact your gross retention. It's also going to impact your net retention. And then obviously churn being lost in this case.
Yeah, and I think there's a couple of other things that I would really encourage folks to think about. There's a lot of comparison, a lot of benchmarking, right? I mean, you mentioned the VCs thinking 90 to 100%. It's really important that you know where you stand within the segment that you support. And and also the kind of business model that you have. So for instance, Snowflake was famously just had 150% NRR, which meant that each year their customers spent 50% more than the year before, which is extraordinary, right? You can get like 50% growth just from existing customers. That's phenomenal. But they are usage based, right? And so, by default, they start small with a project, and every year, as they adopt more, they pay for more. Whereas, let's say, something like Maxio, like you buy the whole thing up front, right? The second year, even if you're using it a lot more, you're maybe not paying a lot more, right? And so I do think NRR and GRR is really specific to how you serve, the segment that you serve. So super, when you benchmark, just be careful on benchmarking.
Awesome. Yeah,
All right.
couldn't
Yeah.
agree more. It's awesome.
All right, logo retention is
Mm.
another one.
Mhm.
So logo retention is the simplest kind of a retention. Is like literally the number of customers count, right? I have 10 customers at the beginning. Now, actually, I'll do the one on the screen. I have 10 customers, 5 renewed, 1 churned. Doesn't matter what the other 4 do, they pay more, pay less. You churned 1, your logo retention is 90%. This is the simplest one. Just count customers at the beginning, at the end, and off you go. I don't really hear this much. It's, unless everyone's paying you exactly the same, which could be true if you're, doing like a SMB, everyone's paying $49 a month. Logo retention really doesn't do much in here, but it's important to know what it is.
Yeah, I think similarly on gross retention, you could do logo retention, and where I've seen it used is when I've looked at deals for companies to buy. You want to look at how many net new logos are they acquiring each month, and so there is this and by segment, right? If there's
Mhm.
churn happening on a logo basis within a small segment versus a big segment, well, what's happening there? Do you not have product market fit? You're
Right.
not providing the right level of service. And so if we're talking about small segments, maybe the customer success team is saying, well, we can't afford to service them. We're doing a community a program forum and we're doing scaled videos, et cetera. But we're losing a lot of customers. And so I do think sometimes the gross retention, if you're doing it at the aggregate level, can mask some of the dynamics that are happening by segment or by region. And so logo retention is a nice complementary metric, I think, to really help understand what's happening with more specificity and triangulating with the dollar retention.
I agree. It definitely have its place. But all ARR, GRR, NRR, logo retention, you have to
Yeah,
track them all, right?
yeah.
It's all on the big spreadsheet. Hey, Randy, I'm going to turn it over to you. Let's talk about some metrics that the CFO cares about that maybe the CCO doesn't think about on a day-to-day basis. So uh, tell me when to move the slides, Randy.
Sure. So when I think about the CFO, their primary responsibility is to tell a CEO what the cash is. And you think about producing the three financial statements, the cash flow, balance sheet, and profit and loss. And that's what they and their teams do each month when they're closing the books and they're not talking to you. They're not going to take coffee with you. They're trying to close the books. That's even before they go to the operating metrics that we were just talking about, the ARR stuff. The number one metric when you're looking at a SaaS company, not the number one, but one of the most important is your gross profit margin, which is telling you how much revenue, how much does it cost you to deliver the revenue that you are gaining? And so when you think about this, it's both your technology, so your AWS costs, your hosting costs, your compute costs, but it also, this is where it gets a little interesting. It does also include some of your customer support folks and success people. So your implementation would roll into COGS. Some of your customer success could be rolling into COGS. And so it is a really important metrics. I know one of those other benchmarks, I'll show you some data on benchmarking. In general, like if you're at 85%, you're running a good, efficient delivery of service in a SaaS world. This is not similar or the same for AI companies where they're consuming an enormous amount of cost to run the models. So the gross margin profile of an AI native or AI first company is going to be different than what we all know is just primary workflow automation, SaaS delivery. You're doing it in the cloud. You got some people to implement and adopt. But I think for a CO, you're going to have a point of view on how to drive efficiencies at the COGS level. So how are you impacting gross margin? And then we'll talk about operating expense at some point. But it's, most of your heads are in operating expense, your technologies and operating expense, et cetera. And so you really should be part of both conversations. How do we solve for gross profit and how do we solve for EBITDA margin?
Yeah, so COGS is super important. Basically, investors really focus on it. And actually, what's interesting is historically there's a debate on what actually goes into COGS, what goes into cost of goods sold. And there was a survey done, which is interesting. And what the survey says, and tell me if you agree with this, Randy, and that is on the right-hand side, customer support is 80% of the time, it's in COGS. 80% of the time, it is part of delivering the service. Only 25% of the time will a company put it in the COGS if you're in customer success. So customer success is generally 70% of the time in sales and marketing. Do you think this sounds right to you?
Yeah, and I think just using that principle of what is it effective, what is it doing? Customer support, implementation, and support is getting customers up and running, and so that's part of COGS. It surprises me that there are companies out there that are putting it in sales and marketing and G&A. I think they're overburdening their OpEx.
Mhm,
And if I were looking at that company, I'd like help me understand
mhm.
why you're doing it that way. And then I think similarly when you think about customer success, a set of what you're doing is helping to get the customer instantiated up and running, and then it's the ongoing um, maintenance. I think there's maybe a little bit of gamesmanship on the customer success side, and the reason why is I do think a lot of investors look at what's called CAC, customer acquisition cost, which we'll get into in a little bit, and you can do new CAC and expansion CAC, and so if your customer success resources can be put someplace else other there, you can sort of break them out. So I do think there's not gamesmanship, but business
I see.
optics. You got to be really
Right.
aligned with your investors on how they think broadly across their portfolios and come up with a, apples to apples comparison with the rest of the portfolio companies.
So you think putting it in the orange, which is general G&A, you think that's a little bit of gain? You like that doesn't
I
make
think
a lot of
so.
sense. Yeah, it doesn't make
I
sense to me.
mean,
How, yeah, how is that G&A? G&A is really supporting the company,
yeah, it's
right?
finance,
Yeah,
HR,
yeah,
IT.
yeah.
So unless that's part of customer success, because one of the things, when I think about customer success, I think of it as the overarching function. Within it, there's three primary sub-functions:
No,
implementation, value realization, and
right,
support. Often value realization is called customer success. So sometimes
right.
are you talking at the highest level of the function, and maybe they have some like biz ops function, which you could
Hmm.
say, well, maybe that's in G&A. I don't know. It feels a little
Yeah.
Gainsy to me.
I bet you that 6% on the left side is the 6% on the right side. Same
Yeah.
people.
Yeah, probably. Yeah, right. Maybe. Yeah, sure.
All right. Well, then you mentioned CAC. You meant so let's talk about that.
Yeah, and so I think this is the biggest aha for me when I started working. I mean, I knew it before I came to Maxio. I didn't rotate it on much. I used to use percent of revenue. So I would say, what percent of revenue am I spending on sales and marketing, R&D, and G&A? And I'd look for benchmarks on that front. And as long as my sales and marketing was a good percentage, I was like, oh, okay, cool. Um, Battery is really focused on this customer acquisition cost in terms of how many dollars does it cost to acquire a new dollar of ARR, and that's basically what you're getting is in this case it's customer dollars per acquiring a specific customer, not dollars of ARR, which we'll go to in a second. But I think for this conversation, Yuman, the subtlety here is can you click to the next slide for me?
Yeah, you bet.
As you go into it, and we'll frame this is really understanding your benchmarks. So if you go to the Maxio website right now, maxio.com, this link or the QR code, you'll find it's a white labeled report that we did in partnership with a really great guy, Ray Reich, who runs a company called benchmarkit.com. And he's done an aggregation, and we support going out and surveying people. I think his total N is about 2,000. And within each one of these sections, we have it on our website. You can go through and you can download the report, and you can use the interface, which allows you to pick different components. So in this case, we're talking about new customer CAC ratio, which I was just mentioning, or CAC payback period. So a calculation from CAC as you move to payback period. In this case, across all of the people that have been surveyed, the average median CAC payback, so number of months it takes to pay back, is 14 months. If you are at 48 months, you're in the first quartile, meaning the worst. And if you're at 2 months, you're in the fourth quartile, and meaning like the best. I don't know. Do we have time, Yuman, to flip over to the benchmark it? Do you want me to
Uh,
share, or do you want to?
why don't you open it up and then you can share
Okay.
because I have
Okay.
my slides up. But
Yep.
basically there's a QR code for you and whatnot for you to do it. Let me actually just explain to the audience, like, because I think this is very important, right? So the CAC payback period is how many months, did you have to have a customer pay you money before you just paid off sales and marketing. That's it, just sales and marketing. And so median, right? So the median number of months is that, the typical company has to own a customer for 14 months and they've paid off sales and marketing. And that's when it starts to move into some profitability, right? And so that's CFOs care about that,
Exactly.
right?
And so what the value of this interactive widget on our website is that you can start to pivot and say, look, CAC isn't the same for a $1 to $5 million company as it is for a $20 to $50 million company, right? The median's gone to 17. You could do it based on
Right.
average contract value. So 50 to 100,000 is 70, and then 10 to 25 is 15. And so you can split it by go-to-market motion, product-led or sales-led. And so when you look at things like we were just talking about gross retention, and you want to benchmark, you could say, hey, we're a 20 to $50 million company. As I mentioned, gross revenue retention less than 85% means that you are down in the worst performers. You're down like in the second quartile. If you get to 90%, you're in that next. Now, let's say if we wanted to go for 10 to 25,000 versus, let's see if my math is right. Yep. So if you're a bigger company, there's an expectation it's a longer sales cycle. Your gross retention is going to be better over time.
Right.
It's harder to extract you. So for each of these metrics that we've been talking about, I think, I don't know, 13 or something, there's different, we were talking about gross margin, right? What's your gross margin? What should it be on subscriptions? Um, Gross margin, third quarter, let's go for a company that's 20 to 50 million, 85% on the gross margin, right? That's you're in that leader category. If you're down below 80% on your gross margins, that's where your investors are going to say, hey, what's happening? For the CCOs out there, the gross margin on service delivery is really different because it's all people. It's not tech. You're not getting the scale from the tech. So if you're making 10% on your professional services, you might want to look at that. So anyways,
Yeah.
I'll flip it back over to you, Yuman.
Yeah.
But on our website, that QR code, you can play with this all day. You have the report you can download. But I think as you're building your plan for this upcoming fiscal year, having some sort of triangulation based on, I like to use company size in terms of revenue and contract value. I think
Mhm.
those two things are the most critical variables that help normalize. If you can get it by end market, like you're selling fintech, you're selling manufacturing tech, that's ideal, but the N is so small. Like having those two dimensions are the ones that are really going to help inform your own benchmarking.
Super powerful is the benchmark. I, absolutely use this tool. The other piece of advice I would have for those of you going through, your planning is benchmark against yourself, right? Like
Mm-hmm.
improvement over time, improvement over time. Because sometimes you can get a good benchmark, and you can always benchmark against yourself. So
Yeah.
I absolutely advise that. All right, let's move on to, actually, there's another chart about, yeah, customer acquisition
This is
costs.
what we
Right,
were trying to
right,
represent by going
right.
to the tool. But here's an example of a 20 to $50,000 ACV. How has this changed over time? The 75th is the top end, 25th is the bottom, and the median. So new CAC ratio, when you look at this, say, gosh, it's gotten more expensive. It's gone from a buck 60 to a buck 76. So that means it's more, and I know I feel this in terms of the dollar per keyword in our business has gone up 4x over the last
Wow.
2 years. And so this is what's true in a 20 to $50,000 company. Can you go to the next one for me?
Mm-hmm. Mm-hmm.
So now look at a 50 to 100,000, you're at 230 is the average. So it's gotten even more expensive to go for trying to acquire companies when you're selling that enterprise solution. And so you got to be super focused on your, it's like going from sales, I always talk about sales funnel to sales cylinder. You got to be super focused on who you're going after, lay in an ABM strategy and try to be more efficient at how you acquire them. And then we'll talk a little bit about why. So that's all sales. It's not really. There's also this whole customer success dynamic to it, which we'll talk about.
Yeah, so let's talk about that. And let's talk about customer lifetime value.
Sure. And so then when you think about bringing the customer on board, obviously the magic of SaaS is they pay over time. And to Yuman's comment earlier about the CAC payback period, the time to get profitable is that CAC payback. If they leave before 12 months and your CAC payback is 14 months, you haven't made any money on them. You spent all your money to acquire them, but they haven't actually generated any dollars. So then what you're really trying to do is get into the lifetime value of your customer. How much money can you expect from these customers? And I think a lot of early stage companies, like they haven't had enough renewals to really know. And so it
Right.
becomes formulaic, their churn rate and artificial. Like they're like, oh, our customers are going to be here for 10 years. They've been in business for like 5. And so Yuman, how do you guys think about, framing lifetime value and the variables you have here to
Yeah.
impact that?
But I mean, if you think about look at the formula, right? The formula is divided by churn rate. The
Right.
denominator is churn. So the only thing that really, really matters is the churn rate. And this is sort of where I think the CCO and the CRO can really sort of get together and understand the impact of servicing your customer, right? And that is retention has an outsized effect on so many financial variables, whether it's lifetime value, and then it will actually go into gross margin, into COGS and profitability. It really is impactful. Now, I do think customer lifetime value, while a super important metric, is one I think is losing a little bit of steam because I think churn rates can be volatile, even from period to period. It will change. It can change abruptly, maybe like when something like AI just comes in and like wipes out your segment, so it changes abruptly, or a new competitor comes in and does something extraordinary at half the price. So it's a dynamic enough rate that I think some folks are starting to say, hey, that's just too volatile a metric for me. I don't know. Are you hearing the same thing?
Yeah, exactly. And I think, look, I think it's a good metric. I mean, then they'll do metrics like LTV to CAC, and now you have this
Yes, let's do
multivariate,
that. Right.
yeah, thing, which is like, oh my God, how all these different factors, it becomes blurred. What you'll hear people say is basically what's the lifetime value of the customer in terms of and over the CAC, the customer acquisition cost, and the rule of thumb is 3. And so you'll hear people say, hey, do you have a 3 to 1? What that helps inform is if your LTV is $450, you don't want to have your CAC be any more than 150. And so then that helps you think about your sales and marketing and customer success expense that rolls up into sales and marketing per that other slide. How much can you actually afford? What's your expense envelope? I think if you stay with the new CAC ratio, and that really
Right.
ties in expansion CAC, you can get actually more kind of value as an operator looking at it versus this feels to me like an investor metric, not an operator metric.
I agree with that, but it is important
Oh
because you
yeah.
will you will be asked. You will be asked, and you have a slide on how to improve LTV.
Yeah, so I think to your point, you said there were 3 things, and you were zeroing in on the churn rate.
I was.
It is your avenue revenue per product or contract. One of the things you saw a couple of years ago when, gosh, it was sort of this compression on SaaS was everyone went out and raised their prices. Salesforce raised their prices 9% across the board. We're seeing this Stripe similarly raise their prices. It's a blunt instrument, but it increases your ARPU. And
Yeah, it
so
sure
I
does.
think there's trying to be super deliberate about what is your pricing or what we describe as your monetization strategy for different customers is important, but you're investing a lot of money and time in building new capabilities. You should be able to monetize them. On the gross margin, oh, sorry. So for customer success folks, this is super important in terms of the expansion motion, assuming the customer success is overseeing the sell in versus that being in sales. And I think
Mhm.
sometimes customer success folks, they feel like we're here for value realization, not monetization. And I think the modern customer success team is like, no, 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 no. We're here to help grow the company, and we need to be able to sell in additional products and services. They know the customer the best, and they're really well positioned to recommend things that are going to help the customer get more value out of the product or increase stickiness versus bringing in a salesperson who's just trying to close the deal. So I think there's a lot customer success can do for ARPU.
Randy, that's a different webinar altogether.
Okay.
Sure. No, it's a fiery conversation within the CS space. Well, hey, let's move to the CCO metrics. So we talked about share metrics, NRR, ARR, GRR. We talked about the metrics that really the CFO cares about. A lot to have to do with, profitability as well as sort of lifetime value. CCOs really are very customer focused, right? So I chose a few um, metrics that, I think those of you in the audience from the finance side, let's educate you a little bit about and talk about the pluses and minuses of them. One is net promoter score. So, everyone has filled out one of these net promoter scores, how likely you are to recommend, something to a friend or a colleague. And it's from 0 to 10. And if you're a promoter, if you answer 9 to 10, extremely likely to recommend, you are a promoter all the way in. And then there's passive and then there's detractor. Um, and the way you do the math is that NPS is a score between -100, which everyone's a detractor, or +100, everyone's a promoter. And it's very easy calculation. The percentage of all your respondents that are promoters minus the percentage that are detractors. That's how you get your NPS score. So between -100, +100, let's talk about benchmarks, like companies like Apple, which people tend to love their products, they're in the 60s and 70s, so super high. Utilities, like electric utilities, they're generally negative. Like nobody really likes their utilities. Like at best, they're passive. They're generally like -10, -20. SaaS, B2B SaaS companies are probably anywhere from the 20s to the 40s. Just, it just really generally where NPS is. So it's basically just a snapshot of how your customers feel about your product and whether or not they're going to promote it. What do you think of this score, Randy? Do you like it? Do you use it?
It's interesting. I was a huge fan of NPS and thought, happy customers buy more stuff and motivate, it ran customer success teams and used this as the North Star metric. It came out of Bain, I think, and they had a
Mhm.
whole set of research around it. And then there's been some recent work. I was looking at an HBR article, which I think we're going to include in the show notes, which says maybe not as causal but still correlated. And so I do think like it's a simple way to measure things. I think if you look at it by product or by region or by segment, it can be helpful snapshot. The other thing I think to your point, you're making the point earlier about what's the trend over time. So we have two effective products. We have a billing product and we've got this SaaS operating reporting revenue recognition. To your point, a lot of people see billing as utility, and our NPS score is lower on the billing product. And the conversation we have is, can we make people love billing?
Right.
I'm not sure, right? It's
Right.
kind of a utility, but it certainly has helped us think about how do we improve our UI and UX? How do we improve the report response time? How do we focus on things that, the double click on this is all your CSAT survey and all the data you're getting. So I think it's a great telltale metric. I'm not as adamant about it as I was 10 years ago.
Yeah, it definitely does not answer the, it's not going to answer the question, are they going to renew?
That's right. That's
It's not
right.
going to answer that question, but it is a big component to understanding if they're happy, which then is a big component of whether or not they're going to renew. I like the metric because it's a simple metric, simple to ask, simple to answer, with a history of benchmarks.
Yeah.
Yeah, I like that.
Yeah.
I always like the simplest metric. All right. CSAT, which is a customer satisfaction score. This is, how satisfied are you with, and then it's literally a task, right? It's or a project. So implementation, the ticket resolution. So when something just happened, something, small or big, this survey can go out called a CSAT survey. And if you answer 4 or 5, that is considered satisfied. And CSAT's score between 0 and 100. And generally, for ticket resolution, you want this to be in the 90s, right? So you want 90% of your folks to be satisfied, 90 plus actually, 95 plus is what I would say. So this is, just a very transactional score. But one, of course, that also leads to customer satisfaction. Do you use this at Maxio, Randy?
We do. And
Yeah,
I don't know if we do a good job of discerning when should we look at NPS versus when should we look at CSAT. I think maybe the way you just described it in terms of NPS is the overarching feeling of working with a company, and CSAT is more focused on a specific delivery of a service or engagement with a product, might be a good way. Um, we do
yeah,
CSAT surveys to your point, kind of at every stage. So at post sales, post implementation, and periodically through the relationship. So I think by stage, by product, it could be helpful. And then the NPS is the overarching, almost like customer health
that's right.
score.
That's right. And it's that all of it is sort of just little steps to really understanding if you're going to get a renewal or expansion.
Yeah.
All right, what else does the CCO care about, right? So another metric that they think hard about, and this is related to COGS, is book of business. And that is how much ARR or how many accounts does a typical CSM own? And I put actually some metrics. There's a very good, and speaking of benchmarks, I'm a big fan of the Keymark Capital Markets and Sapphire Venture SaaS survey. Just do a search for it, and you'll find that it actually does a lot of asks a lot of questions. One of them is your book of business, and so here are the medians here, right? So typical selling to the SMB, each CSM owns about $1 million and 100 accounts, whereas the enterprise CSM will own 2.5 million book of business with 13 accounts, right? So, the simple math there is about 200K average ACV per account. So this is what CCOs think about, during, those of you who are CCOs on the audience, you're thinking about it now because you want to know, what kind of book of business you're going to aim for in 2025. And one of the things that's really pressing hard on all of us on the CS space is, the expectation that automation and AI is going to mean more productivity. And more productivity, guess what that means? A bigger book of business per CSM.
Yeah.
Yeah, what do you think, Randy?
Well, what I think, I worked at Salesforce for, I don't know, 3.5 years. And one of the ways they framed the segmentation was at the very high level, which you don't have here, would be a dedicated CSM. So that's somebody you're paying for just to be on your account all the time. And then the enterprise in this model, I think of as like a named CSM. Like they know who you are, you're doing regular quarterly updates, and then the mid-market is assigned. It could almost be like a pooled resource, but they have 25 accounts, they should know what they're going on. And then I think that SMB is really that scale motion. It'd be very hard for an individual to know 100 accounts unless they have a lot of automation, to your point, and able to get clarity. And it is, I think they're very different CSM plays for each of those four. But I think the triangulation, like our CSMs are in that zone. I think that we're averaging about 30 accounts for the
Right.
people that are mid-market enterprise, for us.
Yeah, you bring up a good point. And also, I'm looking in the Q&A. Cecilia asks, is the number of accounts in the portfolio or up for renewal in the rolling 12
Oh,
months?
yeah.
This is almost I can't say 100%, but I would say 90%, these kinds of questions, it's your total number of accounts in your portfolio, whether or not they are on a 3-year, renewal or, 1 month renewal.
Yeah, I think
Yeah.
from my experience, I'm primarily like an annual contract guy. This is
Mhm.
super aligned with annual contract book. Because I think of them, the person having to know who the account is, and they're going to renew over the course of the year. You're not going to have all 25 at the same time. Most of them are going to be end of year, fiscal year. But you are going to have other ones. But the work of like the enterprise account, like we want our CSMs to be interacting with those accounts once a quarter and doing a check-in,
Yes. Right.
and for the mid markets, I think it's once a year or maybe every 6 months. So it's a different expectation of work.
Yeah, your go-to-market, your ability to service the customers has to be vastly different. Your playbooks are vastly different between the enterprise and SMB. All right. Hey, Randy, we have a few more minutes left before we go to Q&A.
Yeah.
So I have one more metric to go over. I want folks on the audience to start giving Randy and myself some questions about what we've been talking about. So just giving you all a heads up before we go to Q&A. All right, the last one is customer health score. Okay, so it's a metric. By the way, this is not, I mean, the health score is very dynamic, very custom to individuals. But the idea is to have a sort of a singular score that measures the overall well-being and success of a customer relationship. This is really hard, and there's a lot of things that can go into it. And I'm actually going to go into, just give you sort of a crazy list of things that can actually go into a health score. And I will preface this by saying, if you put all these things in the health score, you took the wrong lesson. Do not. These are just examples. I would say a typical good health score, you have anywhere from like 5 to 8 of these. And I want you to think about, and you can see this is really a quadrant. You have objective metrics like usage, right? There's just objective, right? Either they use it or they don't use it, to subjective metrics like NPS and CSAT. You also have subjective metrics, like the CSM's opinion. Oh, the CSM's, oh, we have a great relationship.
Mm.
Or an objective external one, like the upper right-hand corner, objective and external would be, oh, let's say like COVID hit, okay, and and if you're in hospitality, guess what? it doesn't matter. It's objectively, a terrible thing that happened to hospitality. It's an external input, and it ruined, all those customers. And even if they're great customers, they have to be considered unhealthy just because of the economy. So a lot of things can go in this thing. So just take a look at this. This is actually, once again, this is a webinar unto itself, and we actually have had webinars on customer health scores. But these are the things that could go into a very solid health score. And I would advise you putting, things from each section into a health score.
That's what I was going to say, Umanis. Pick one from each category. I think if
Mhm.
your workflow automation, usage by users is the probably primary indicator of whether or not they're getting value out of the product and being able
Right.
to track usage by product. Why I bring that distinction is because I do think there's a distinction between user and buyer or user and exec sponsor. And so if you have a good relationship, like you and I both go meet our customers and try to build a relationship with the person that's signing the check,
Mhm.
they're going to get the input of the person that is using the product, but they're going to have their own motivations. And so I do think your exec sponsorship relationship is another one of those. Like, do you have, for your biggest customers, do you have an executive relationship? Have they been in place? I often find, which is interesting when I talk to a customer, is they'll tell me things they aren't happy about, and I'll be like, oh,
Mhm.
or I find they're not using all the products they could be using, and so there's a real opportunity for your exec sponsor program to help inform your and triangulate and or validate the health score.
Absolutely. Yeah. And by the way, I'll tell you what validates your health score is your renewal rate.
Sure,
Right.
100%.
Yeah,
That, but
absolutely.
getting
Yeah.
in front of it,
Yeah.
anticipating your forecast.
Yeah. Agreed. All right. Okay. Before we move to Q&A, one more poll. Okay. After all of this, we've talked about
Mhm.
all of this. For those of you in the audience, whether or not you're on the CS side, whether or not you're on the finance side, and please answer this question. For you in the finance department, for you in the customer department, which customer metric is most important to you? And there's a lot of metrics, right? So we've talked about, so we're just giving you a representative one. I know what do you say, Randy? As people vote, do you have
Mm,
which one do you like?
I think if you don't have gross retention sorted out, nothing else matters.
Interesting. So you like GRR.
Yeah, I mean, you hope to get to NRR, but I
Mm,
think of like you got to secure your customer base because if think about it, if you've lost customers, then every new year when you start with your bookings target, you got to dig your way out of the hole that you lost
mhm,
to be able to demonstrate growth. So if you're trying to grow, build a high growth SaaS company, like addressing the leaky buckets, securing your customer
mhm,
base, I think that also helps. People talk about product market fit, and I'm always like, well, product market fit is you don't have product market fit until you have a regular cohort of customers that you can define that are
mhm.
renewing and growing. So that would be NRR would be the next step. But the first step for me is you got to get your house in order around gross retention.
All right. Well, let's see what
Ah,
folks
okay.
say. All right. Well, it's interesting. I agree with you in the long run,
Mm,
right? In the long run, GRR I think matters the most because that is, over the span of 10, 20 years, it basically means the higher the GRR you have, the better sort of the offering that you have, right? Which I think counts in the long term. In the short term, you can hide a lot of sins by upselling, cross-selling,
mm,
focusing on, and you can grow like bananas with great NR and poor GR, right? In the short
mm-hmm,
term. In the short term, in the
mm-hmm,
long term, it does catch up to you.
mm-hmm,
All right, so it's interesting. CSAT has made a look. CSAT's got a little bump there, right, as the most
mm,
important metric. So, um, but yeah, I mean, look, bottom line, it is the financial metrics that really matter. Okay, before I go to the first question, let's I'll bring you back to this slide, and that is for those of you are thinking about all these metrics, please, this is a great resource. You can see where you stand and where you should be aiming for in 2025 and beyond. So let's do that. All right. So let's go into Q&A. Those of you who are interested in learning a bit more about Maxio or ChurnZero, there's a couple of QR codes for you. Let me let me go ahead and scan these questions. Okay, here's a question. Let's talk about implementation.
Mm.
Um, where do you think implementation should go in COGS? Is it in COGS or is it not in COGS?
Most of the people I talk to, it's in COGS because it's getting the customer instantiated on the platform, getting them up and running. It's often with a team who isn't going to be the users of the product over time, but it's like the IT team or the go-to-market team or your MOPS or your CS ops team that's helping to get the product up and running. So I
Yeah,
see it in COGS.
I fully agree. It's in COGS if it's necessary to, it's a necessary part of your business, right? If it's a necessary part of run your business for the product itself. Will your customer effectively use the product without implementation, without support? The answer, you could answer yes, they could. They're on their own. They implement on their own. They support themselves, I suppose. But for most people, they put it in the cost of goods.
Right. Well, you wouldn't have, I mean, if you had a pure PLG motion product where people are get up into self-instantiation, you wouldn't have an implementation team. So I
Mhm.
think if you have implementation tied to the deployment of the product, it sits in COGS. I thought you were going to say something slightly different, which was there are a set of professional services you could access or deliver in an implementation time period that are voluntary or discretionary that aren't tied to the delivery of the core capability for you to, because the thing you're trying to do is get to rev rec. You want to be able to get the product out and customer up so now you can recognize the revenue. And so those professional services that are done during the implementation phase, I'd have to ask my CFO, but maybe those sit
Mm,
under OpEx.
mm.
But the core, you're getting the product up and going, you're getting them set up, you're getting their, for us, you're getting their data migrated, you're defining all the financial processes. I think it's COGS.
Yeah, okay, yeah, right. Carl has actually a comment, and I wanted to share this with you. It's interesting metric. So a metric that Carl likes in CS is that with larger accounts, they want to know, one, basically, if they're happy, are they making an impact on new sales? So one, are they referenceable,
Yeah.
right?
Hmm.
Two, have they referred new logos and new
Hmm.
dollars?
Hmm.
Do you see this as a metric, that's used across SaaS companies,
Yeah, I
basically,
think
yeah,
I
go
think
ahead.
everybody, we call it the passionate champion program, and we have three different levels of passionate champion. And part of it is to help close deals. So, are they willing to be a referral? Number two is, are they a case study? Number three is, will they do like a webinar for us or something
Hmm.
along those lines? The assumption is, if they're a passionate champion at that level three, they're most likely great fans of the product, and so it totally aligns with the health. I think that you find in the sales motion, you don't want to beat up your reference customers too much. So it's really important for CS team to continue to try to find people who are okay with using a quote or they're
Mm,
okay with being a reference, but you're only going to be a reference once a month versus they're going to go do a case study with you. There's different levels of commitments. In my past, I have set up contracts where we'll give a discount for a customer for a case study and
mm,
we'll say, at the end of the year, if you're satisfied, we meet these criteria, you'll do a case study. So they've gotten a discount for it. But in
mm,
general, you want people, you want to go find your passionate champions like what
right.
Salesforce does. They just do extraordinarily well with this.
Yeah, I agree. I think, Carl, I think it's a good, it's can be difficult to measure, but I think it's interesting. By the way, Randy, have you heard of something called CSQLs?
Yes, and we
Yes.
use them. We've introduced those in our deal flow to identify out because our CS team owns the upsell and cross sell, and so we need them, and they don't have quota around it, but is something that we're tracking, especially for our high end. We've had to go through and segment all of our customers and understand where there's opportunity, and for those customers who have opportunities, we're having the CS team tee up CSQLs.
Yeah,
Absolutely.
let me identify it. So these QL things is qualified lead. And for a very long time, there's MQLs, which is a marketing qualified leads, but generally marketing has brought them in. So a CSQL is the customer success team has identified a lead for sales to close. Now, oftentimes this is cross sell, sometimes this is upsell. Sometimes I think it's even like a new logo. but basically CS has kicked it up. So folks are starting to say, hey, if the CS team actually generates this lead, that gets closed, uh, let's measure that. And I think it's pretty interesting. You could imagine a lead that gets kicked up from a customer by CS would be a very high, like a really a great lead, probably the best lead you would have. That's probably fair to say, right, Randy?
Yeah,
Yeah.
yes, I think so. And just for us, we're primarily we have CS led opportunities. I think in larger companies, they may have the AEs be responsible for expansion as well. So it's a kick up to the sales team and then gets rolled into their pipeline. And basically, you're just looking at the highest level. You're looking when you go back to your the first part of metrics. ARR growth will come from
Hmm.
new ARR closed with new logos or expansion. And you want to be able to look at source of ARR leads from
Right.
marketing, BDR, partners, and CS. And so I
That's
think
right.
when you have a CSQL, you now have another source of ARR, and that helps inform, well, how much are you going to invest in that and do customer marketing, et cetera, support training for your CS team. So it's a source of new ARR, and ARR growth is what we're all gunning for all
Right.
the time.
All right. Another attendee, anonymous. Now this is a very CS metric, so get ready for this, Randy. All right. So this is the percentage of the success plan achieved over time.
Hmm.
So, a success plan really is what is your product and service trying to do for your customer? And are you successful in doing that? So, maybe if you're say, just call it an e-com site, you're really trying to generate revenue growth, right? Hey, our e-com site is so great, they're going to all your customers will buy more, right? And so that would be the success plan. For ChurnZero, it'd be like, hey, I want my retention to go up 5%. Are you going to achieve that? So a metric to do that is what this person implies. Now, I have a quick opinion on this, Randy, and so I'll share it, and maybe you can share your own. I think success plans are super important. I think it's hard to do apples and apple to apples, right? Because each individual customer can be pretty different. Some customers may have very achievable goals. Others may want you to fix their company. And so, I like a metric that feels like it is stable over time, rather than, subject to the vagaries of, hopes and dreams. I don't know any thoughts about that, Randy?
I think it is best practice. This goes back to the segmentation you had in terms of you can't do it if you have 100 accounts. But if
Hmm.
you have 13 accounts, everyone should have a success plan. And much like
Right.
in the sales motion, the thing called a MAP, mutual action plan, where with a prospect, you sit down and say, these are the set of things we're going to do to get us to a closed deal. I think you should sit down with the person across the table, the primary user, and define what does success look like for this relationship. And that success plan is the framing of that. And then, yeah, what is it's like a mutual action plan, right? You're just agreeing to that relationship. And then every quarter when you're meeting, you go back and you dust off the success plan and said, hey, these are the set of things we're going to do over the last quarter. Did we do them? So some of the success is just getting stuff done.
Mhm.
That could include feature requests. So customers could say, hey, I'm struggling with these things. And you as a customer success person need to really manage that with your product team to find out when those requests are coming. So you're setting expectations for when this is going to be delivered or when it's going to be considered, and you close the loop on that. And that can cause a lot of consternation with customers, is that they feel like you keep showing up as a customer success professional and you
Mhm.
haven't delivered
That's right.
on what they said.
Yeah, there's nothing that feels worse than that. Well, hey, we're on the top of the hour. Randy, hey, thank you for spending this hour with me and having this conversation about the metrics. The metrics, for a modern company is really what CEOs care about. So it's good to sort of have the conversation on the CFO point of view and the CCO's point of view. So Randy, thank you. I hope everyone in the audience enjoyed the conversation. And if you want to learn more about Maxio, there's your QR code on the screen. And if you want to learn more about ChurnZero, or where the QR code on the left. Randy, thank you. You have a great day, and everyone out there. Have a great rest of the day.
My
See
pleasure,
y'all.
you, man.
Okay, thanks, Randy. See everyone.